So chapter 8 as a whole is on internal controls. All right, that's where we start chapter 8. Then after we introduce internal controls, we're going to start looking at internal controls related to cash specifically. And then each chapter as we go through, we're going to look at how internal controls play a vital part in those chapters and in those items. Okay? So we use controls every day of our life in a lot of different ways. You just may not think about it. When you leave your car on campus, before you go into your room, what do? Lock it? Why do you lock it? Make sure nobody steals your stuff, right? All right. Just because you lock it, does that mean that nothing's going to happen to your car? Why not? Like, I mean, if someone is dead set on breaking into a vehicle, then they're not going to let the lock stop them from doing it. But the lock is set up as a control to keep people from breaking into your car. Same thing with a lock on your house.
What if you don't lock your car?
Do what?
What if you don't lock your car?
Well, then your control. So there's a control there to lock your car that keeps people from stealing it, but your control was not effective because you didn't lock it, or it was not operating efficiently. So if you have a lock and you don't use it, what's the purpose of the lock? You're not using it the way it's intended. All right, same way with a lock on your house. So you have a lock on your house to hopefully keep people from breaking in, but if you have a lock and you don't use it, then there's no barrier to persuade people not to break into your house. All right, so those same things, those same concepts work in the business world in the accounts that we're going to discuss today. Okay? So, last semester, we talked a little bit about the Sarbanes-Oxley Act. When I was in school, in high school actually, is when the Sarbanes-Oxley Act came out. So when I was in college, it was in its infancy. It was still being implemented amongst corporations and still being implemented. The kinks were getting worked out. They were finding loopholes that they were closing and things like that. But the Sarbanes-Oxley Act is one of the most important laws that have happened in accounting and in corporate governance, I would say, in the 21st century. Okay? Some backstory, there were lots of fraud that was being discovered. The reasons that it was being discovered, there's a lot of different reasons. One of the main ones was that companies were getting way too friendly with their auditors. Okay? And if you're an auditor, you have to consistently be skeptical as you look at everything. All right, so if you become best friends with the CFO of a company, then that's going to skew your thinking. You're going to say, well, Joe wouldn't do this. He wouldn't cheat. He wouldn't look for ways to hide losses. He wouldn't look for ways to cover up things that weren't truthful. I know him. He's a good guy. He wouldn't tell me anything that wasn't true. Add on top of that a lot of companies were giving these auditors lavish gifts, vacations, tickets to sporting events, things like that, which further clouded their judgment. So it made it difficult for auditors to have objectivity when they looked at financial statements. Okay, the companies obviously knew this, so most likely one of the reasons they kept doing it. So as a result, we were uncovering these large amounts of fraud. WorldCom, Enron, Waste Management, a lot of different companies with these huge dollar figures that were uncovering this fraud. And so the public was losing trust in the accounting profession. So the Sarbanes-Oxley Act set to basically restructure the way that audits were done, put a lot more rigidity and rules in place that would keep companies from being able to do this over and over again. Now, did the Sarbanes-Oxley Act completely wipe out fraud? No. Why not? Because if you're dead set on hiding losses, and you're dead set on trying to manipulate your financial statements, that's not going to stop you. It'll just cause you to look for some other way to do it. Okay? So, the Sarbanes-Oxley Act only applies to companies that are traded on the New York Stock Exchange. The large companies, Best Buy, Walmart, Apple, Disney, Nike, all those companies. If you are a larger company, but you're not traded on the stock exchange, you are not required to abide by the Sarbanes-Oxley Act. Now, in saying that, there's a lot of good points here that if you're able to implement in your business, it would be very wise to do that. And some companies have. But some companies have cash restrictions, employee restrictions, they don't have enough people, so you can't implement everything. All right? So the Sarbanes-Oxley Act emphasizes the importance of effective internal control. And internal control is defined as the procedures and processes used by a company to safeguard their assets, process information accurately, and ensure compliance with laws and regulations. So do you see similarities between this and what we talked about in Chapter 7? So with inventory, one of the main reasons, or one of the main concerns with inventory is to safeguard it, make sure it's not stolen or ruined, and to make sure it's reported correctly. That stems from the Sarbanes-Oxley Act. Okay? The Sarbanes-Oxley Act also requires companies to maintain effective internal controls over their financial statements. And we're going to see exactly what that means. But basically, before Sarbanes-Oxley, companies did not have to attest that their financial statements were true. And then if it came out that they weren't true, they weren't necessarily penalized correctly for presenting these untrue financial statements. Now that Sarbanes-Oxley's passed, they write a report that says, we stand behind these numbers, they are truthful, and if there's not, there's serious repercussions for the management. Okay? So this goofy picture right here that you probably can't see, it tells a good story. So prior to the passage of Sarbanes-Oxley, weak or non-existent internal controls gave way to fraud and theft. Well, who was negatively impacted by the fraud? Investors, employees who might have had their retirement in those companies. Basically the public. The public eye was the recipient of the negative impacts from these weak internal controls. Okay? After the passage of Sarbanes-Oxley, there are tightened internal controls. Still not 100% certainty that no fraud will occur, but there's effective internal controls. So now investors in the public eye can have more confidence when they look at a company's financial statements. Okay? So another thing that happens with the passage of the Sarbanes-Oxley Act is that management has to put out a report that does not necessarily list the internal controls that they use. That wouldn't make a lot of sense, because then that would allow people that are looking to abuse them, give them a list of everything there is. But they have to put out a report that says, hey, we have enlisted internal controls to make sure that these things are frowned upon, and we stand by the effectiveness of those internal controls. Okay? So it's it was a landscape-changing legislation. All right? So what is internal control? So internal control is, we're going to see in the chart, there's an objective framework that companies use to design, analyze, and then turn around and evaluate the internal controls that they put into place. Okay? I see a couple of people on their phone. You guys need to put them up here on the table or put them under your backpack. So that shouldn't be an issue that we have during class, okay? So in this section, the objectives of internal control are described and then discussed on how they can be achieved using this integrated framework. So let's look at the 5 elements, okay? So the objectives of internal control are to provide reasonable assurance that assets are safeguarded and that they're used for business purposes, that business information is accurate, and that employees and managers comply with regulations and laws. So look at the wording here. The objectives of internal control are to provide reasonable assurance. Reasonable assurance. Why is it not absolute assurance? In other words, this says that that the objectives of internal control are not going to provide 100% certainty that all these things are carried out. Why is that? Why can it not say with emphasis that it's going to knock 100% of fraudulent activity out? Yeah. If I tell my kids, if I lay a cookie in front of them and I say, look, I'm about to leave for a minute. If you don't touch that cookie, then when I come back, I'll give you 5 cookies. I have 3 kids. 2 of them would go ahead and eat the 1 cookie. They wouldn't wait. My middle son, he would do what I asked and he would wait and then he would get rewarded greater. But with employees are people. People make mistakes. No matter if they know the consequences that are coming or not, some people can rationalize that the decision they're making is what's best for them, even if you know that it's bad for them. Just like when you were little and your mom told you not to touch the stove. Well, that just makes you want to touch it more, right? Your parents tell you you can't do something. But they tell you that to protect you. And so that's what these internal controls are for. They're for the company's protection, but they can't make sure that 100% of employees are going to follow every control and procedure that's set up. Because we're human, we mess up, we make mistakes. So by providing reasonable assurance, that means that these are set up to catch most fraudulent activities. Okay? So internal control can safeguard assets by preventing theft, fraud, misuse, or misplacement. So employee fraud is one of the largest sources of fraud. Whenever, and I mentioned this in my last class, but the whistleblower hotlines that were put into place in the early 2000s, those have captured more fraudulent activity than ever thought was possible. And it's because employees can rationalize anything. And I don't know if we get to it or not, but the fraud triangle, there's a triangle, and it says that if you have an incentive to do something, you can rationalize why you're doing it, and based on your circumstances, then you could do things that are completely unlawful, but in your mind, they seem okay. So, say that your husband got laid off at work, and you have access to the company's checkbook. Well, your family has to eat, so you think that you're going to try and start skimming off the top of the company's bank account. So in your mind, you're rationalizing that my family has to eat, so I need to do this. When in fact, it is an unlawful activity that if you get caught, you can go to jail. But in that moment, the employee does not rationalize the consequences of their actions. So employee fraud is a big thing, even still today. It's one of the largest sources of fraud amongst companies. Okay? So it's the intentional act of deceiving an employer for personal gain. So it could be something simple, like overstating your expense report, or your travel expense report, up to stealing millions of dollars, depending on how long it goes on and how long it goes undetected. So I'll give you an example. When I worked at KPMG, on our first day of employee training, they told us about our expense reports. So every 2 weeks when we turned in our time card, we had to fill out an expense report. So if we were traveling out of town, there were a couple of different things that we got to do. So first, we got a per diem per day to eat on. But if you spent more than 3 days consecutively out of town, you were able to get your clothes laundered. So, your shirts sent to the cleaners, things like that. Anything under $25, you did not have to show a receipt for. Okay? So, if you're a truthful employee and you want to do things the right way, not jeopardize your job, things like that, then you're going to do exactly what they say. You're only going to use the benefits when they're allowed. You're going to turn in your receipts when they're supposed to, and you're not going to step into any of that gray area. If you're an employee who likes to get as much as they can out of it, and sometimes they like to do things that are in the gray area, then there would be an opportunity there for you to steal extra money from KPMG. If you stayed out of town 3 weeks or 3 days, you could submit a receipt from the cleaner, or you could submit a charge from the cleaners for less than $25. You did not have to provide a receipt, and they would reimburse you for that. Now, is that truthful? No. Is there a way for KPMG to double check that? Probably, but they wouldn't because of the $25. That's immaterial to them. But ethics come into play when you talk about internal control too. So you know that's illegal to do and you're stealing from your employer, but I saw plenty of people do that. So employee fraud is a big issue with companies. Okay? So what are the elements of internal control? So those 3 internal control objectives that we talked about: safeguarding assets, making sure employees obey laws, and then providing factual financial information. Those things can be achieved by applying these 5 elements of internal control to all aspects of your business. So, what are the 5 elements of internal control? The control environment, risk assessment, control procedures, monitoring, and then information and communication. Now, they go in order. And for them to be effective, you have to go in order as you walk through these and set them up. Okay, so let's talk about each of them. So, the control environment. So the control environment is basically the tone at the top. All right. So take my example from KPMG on my first day. If our manager, when they were explaining the expenses policy to us, came in and they said, look, if you choose to break this rule and you're caught doing it, you're automatically fired. There's no chance to explain. There's nothing. We stand behind truthful reporting. It is paramount for us to have a successful company. And they let you know, hey, we are sticklers by the rules, and we are going to investigate things if they look different. Then that would give you as an employee a sense that, hey, I don't need to break the rules. They're serious about it, and I'm going to obey the rules because I want to keep my job. On the other hand, if they had come in and said, hey, this is our policy, use it how you wish, and they were very lackadaisical about it and almost encouraging you to stretch everything you can out of it into the gray area, then that's going to give you a different mindset. You're going to think, hey, management doesn't mind. It's there for me. If I want to use it, I know it's there and I can use it. So the tone at the top is huge for employees. If you set a tone of compliance and you pass that down to your managers, and you emphasize, hey, we want to be a company that does everything right. And then your managers take that same philosophy and they pass it down to their employees, then you're going to have a company that is well run. Whereas if you emphasize to your managers, hey, we want to do things the right way, but if there's a way for us to cut a corner, look into doing that. And then your managers take that emphasis and they pass it down to their employees and say, hey, we want to do things right for the most part, but if there's a way for you to cut a corner, to save a little bit of money, go ahead and do that. Then that promotes a system of non-compliance. And there could potentially be some big time mistakes that happen because of that. So the control environment includes the following. So management's philosophy and operating style, which we just talked about. The company's organizational structure, and then the company's personnel policies. So if you're a huge company, then it's a lot easier for you to have your philosophies known at times, but the downside of that is there's also possible for you to kind of slip things through the cracks. If you are a smaller company with very few employees, then it's less likely for you to be able to slide things past management, or for you to be able to get things over on them, or for fraud to go undetected. Okay? When you talk about personnel policies, that goes back to the training, like I talked about. So the control environment sets the tone at the top, and all the four other elements of the internal control framework are based off of the control environment. Okay? So let's look at risk assessment. Okay. We were talking about this in strategic management to an extent. So risk assessment. You as a company and you as an employer, if you're in management, then you need to be able to look at your business and identify risk and say, this is the way that we're set up. These are some potential ways that employees could prevent fraud if they wanted to. These are some ways these are some areas that we are weaker in. These are the areas that we're stronger in. But these are the areas where fraud could be likely to occur. If you're unable to do that, and if you as management are unable to see where there are weak spots in your company or in your organization, I guarantee you some of your employees see that. And they're going to be able to pounce on that, pounce on your lack of foresight. Okay? So, all businesses face risks, such as changes in customer requirements, competitive threats, regulatory changes, and changes in economic factors. So look no further than the pandemic. I mean, companies could not have foreseen, I don't think, in early March of 2020, that in January of 2021, we would still be in the middle of a global pandemic. Okay? So there's a lot of risk that come with that. There's a lot of risk that came with it in March, and even more so as we continue to navigate through these things. Okay, so management's willingness to adapt and to be able to see those risks will help them in coming out on the other side in a positive way. Okay, so you set the control environment at the top. Then you go through your company. And the way companies do this is they go item by item. So they would look at cash and they would say, hey, what are the risks associated with our cash account? What are the risks associated with our cash employees? And they do the same thing for inventory. Do the same thing for accounts receivable. Do the same thing for accounts payable. And they go through all the different areas of their balance sheet and financial statements and see where do we have risks that we need to address. So you go through your company and you address those risks. Then we have a list of things that we need to figure out and things that we need to do in order to make sure that our employees aren't able to prevent fraud or to have fraudulent financial reporting. And there comes your control procedures. So control procedures provide, once again, reasonable assurance. So we don't have absolute assurance. There is no absolute assurance in the business world because people are human. Humans make mistakes. So control procedures provide reasonable assurance that business goals will be achieved, including the prevention of fraud. Okay? So control procedures, which constitute one of the more important elements of internal control, can be emphasized by these steps right here. By hiring competent personnel, by rotating duties, mandatory vacations, and we'll look at how those can be considered a control procedure. Separating responsibilities for related operations, separating operations, custody of assets and accounting, and then proofs and security measures. Okay, so we set a tone at the top that we're going to be truthful in everything that we do. We're going to look to do things the right way. From there, we've gone through and we've assessed risks, and we said, hey, this is where we're likely to experience fraud if it happens. So knowing that, now we come to step number 3, where we implement these controls that will catch fraud if it's trying to, or that will catch employees if they're trying to do things that may result in fraud. Okay? So let's look at how that happens. So the first bullet point, competent personnel, rotating duties, and mandatory vacation. So let's all step into the shoes of an employee that is committing fraud. Okay? So put on that hat for a minute. Okay. So you work at a small company and you have figured out a way to steal money from the company. Okay? Now, if you have a system that works for you and you have mastered this system, you're either printing fake checks or you're skimming money off the deposits, things like that, would you want to go on a vacation and give someone else the chance to look at your work? No, because if somebody else comes in and they sit in your shoes and they're like, hey, Josh he's not doing things the right way. And then you dig a little deeper and you're like, he's not been doing things. Hey, Cameron, put your phone down. He's not been doing things the right way for a long time. And then they go and tell the boss, and while you're on vacation, it comes out that you have been committing fraud. Hey, Cameron, put your phone down, man. Do what? You looking at the book?
I'm looking at a book.
The book?
No, not that book.
All right, let's wait till we get out of class. So mandatory vacations are a way to deter fraudulent activity because employees would be scared to go on vacation. If you have a secretary and you say, hey, Josh, you haven't been on vacation in 3 years. You need to go on vacation. I'm like, no, I don't want to. And there's pushback there, then that should be a red flag that something might be happening that's not truthful. Okay? Rotating duties, for the same reason that mandatory vacations are a control procedure. So if you have 5 employees and they all do different things, it would make sense to rotate those duties, to let all 5 employees become competent in all of those areas. If somebody got sick, somebody else could fill in. If somebody was out, if somebody got hurt, then you wouldn't necessarily have downtime in your workplace. And also, if you found a way to figure out how to scheme the company, then by rotating duties, somebody's going to figure that out. So by rotating duties, it keeps everyone sharp. There's always a new set of eyes looking at procedures. So those are good control procedures. Okay? Separating responsibilities for related operations. So, and the book is going to say this, but these are much easier to be regulated in a large company. So if you work for an insurance company, you're the insurance agent, you have a secretary and 1 agent. It's kind of hard for you to separate responsibilities because there's 3 people running the whole business. If you have 100 employees, then it's a lot easier done. So that's why, but all of these are from the framework of the Sarbanes-Oxley Act. So these are large companies. They can easily achieve the things that we're talking about here. Okay? But say that you are the cash clerk. Okay? And your job is to open the mail, fill out the deposit slip, and take the deposits to the bank every day. Okay, that's your job. Open the mail, fill out the deposit slip, take the deposit to the bank. Would it be possible for you to steal money from the company? Yeah, because you're the one that opens the mail. You're the one that fills out the deposit slip. And you're the one that takes the money to the bank. So if somebody mails in a $100 bill as payment, you just put it in your pocket. You're the one that fills out the deposit slip, so no one's going to know. And you're the one that takes the deposit to the bank. Now, compare that to someone opens the bank, someone opens the mail, someone else fills out the deposit slip, and then a third employee takes the deposit to the bank. Well, now, it's still possible for fraud to happen. But for that to happen, those three people would have to work in tandem. So while it's still likely, it's less likely than if one person has all of the operations doing the same thing. Okay? So the responsibility for related operations should be divided among two or more people. It decreases the possibility of fraud. It doesn't 100% wipe it out, but it decreases the possibility. Okay? And then this gives the example of ordering supplies. So if the same person orders supplies, verifies the receipt of the supplies, and pays the supplier, they could have used a lot of different things. So they could say that they ordered a lot more than they did. Then they look at the receipt, say, yeah, we got everything we wanted, and then just pocket that cash. Or if you needed 50 iPads for school, but that person ordered 75, they could go and sell the other 25 on Facebook or eBay or something like that. So separating duties is vital to making sure that you have proper reporting. Okay? Then lastly, proofs and security measures. Okay? In certain companies, if a purchase is above a certain threshold, then it takes manager approval. So go back to the iPads. Say that anything over $1,000 has to have manager approval. Okay? Is it possible to have employees that could still achieve fraud in those circumstances? Sure. But they would have to have the manager in on the fraudulent activity to be able to get those things passed. So it doesn't 100% wipe it out, but it makes it less likely and harder to achieve by having these control procedures in place. All right, so control environment, we set the tone at the top, then we assess risk. Then once we see our risky areas, we implement these control procedures. Once you implement the control procedures, you have to monitor them to make sure they're operating effectively. Okay? You buy a car, the car has a door lock on it. If you use the door lock effectively, it is most likely going to deter a robber from stealing something out of your car. If you don't use that control procedure effectively, then it's not going to achieve what you set out to do. Okay? Same thing in the business world. So monitoring the internal control system is used to locate weaknesses and improve on controls. So whenever you are assessing risk, it's possible that you didn't think of everything. So when you go and you implement your control procedures, you monitor them and you say, hey, we left this area wide open for somebody to prevent fraud. So we need to go back and address that when we decide if it's operating effectively or not. Okay? So, warning signs of internal control problems. So if you own a business, people are not the smartest. Okay, we as a people are not the smartest. And that shows itself in a lot of different areas, okay? Normally, people that are fraudulent in their activity and people that are stealing from a company, they are not smart at covering that up. They may be smart about covering it up at work, but at home they're not smart, okay? If you're stealing money from the company, say that you're a secretary or an assistant, and you make $35,000 a year, and you're single, and you're driving a Ferrari, and you have a $300,000 house. That should be a red flag. Okay, if you're making $35,000 a year, and you live in a house bigger than your boss, and you drive a car nicer than your boss, those are red flags. Okay, so you would think if you were taking all this money, you would figure out a wiser way to conceal it. But we're just not smart as a people. We're just not. So, warning signs with regards to people. An abrupt change in lifestyle. If you have a close relationship with a supplier that your company buys from, that could be a red flag. Refusing to take a vacation, we already talked about that. Excessive use of alcohol or drugs, or frequent borrowing from other employers. Those are just a few. But, those red flags are going to come up as you come to work every day and as you work for the company. Okay, it's just things for employers to keep an eye on. So the book gives eBay as an example. And a way to reduce fraudulent activity, if you win multiple items and don't pay them, then they suspend your account. Or if you have, you're continually selling things and then you never make good on your sale, they're going to suspend your account. Those are just simple ways that they can circumvent fraud. Okay? All right, so the last step. So you set the tone at the top, you assess your risk, you implement controls, then you monitor them to say, hey, did we get this right? Did we get this wrong? How can we improve this? Maybe we went too far on this one, so we need to scale it back. The last step is information and communication. So you basically come and circle around a round table, and you say, this is where we got it wrong, this is where we got it right. How do we move forward? Making sure that we have the best procedures in place. Okay? So, management uses external information to assess events and conditions that impact decision making and external reporting. Okay? So, a lot of times, some of these things are made for you. Sometimes you have to do them yourselves. Okay? So, this example right here is talking about the internal control elements. So, look at these three things and decide, is this part of the control environment, part of risk assessment, or part of control procedures? So mandatory vacation, that is a control procedure that is set up to deter employees from fraudulent activity. Personnel policies, that's control environment. You're setting the tone at the top for the way that you want your employees to work. And then lastly, report of outside consultants on future market changes. That's a risk assessment. You're trying to get ahead of the game and see where you might be susceptible for failure in the future. Okay? So the internal framework, and then it goes into limitations. Basically, the limitations are the human element. People are not smart. If you give us an opportunity to cut corners, some people will, some people won't, but there's always that opportunity there. And then a lot of these things, there's a cost-benefit analysis that you have to go through. Is it worth it to hire extra employees so that you can rotate duties? For some companies, yes. For some companies, no. And each company has to go through and make a decision based on their limitations and their accessibility, things like that. Okay? All right. So that is the internal control framework. On Tuesday, we will go over how that applies to cash and some certain control procedures that are set up for cash to make sure that we're always checking ourselves.